Hi, I'm Takoa De Silva. With me today is Rick Rule, founder of Rule Investment Media. Rick, welcome.
Takoa, thank you. It's a pleasure to be on with you.
Likewise. Rick, I'd like to ask you today about the decade of the 1970s, your experiences and observations as a person living in the US and Canada, but also your unique experience and reflection as a natural resource investor. And for the person watching, during the decade of the 1970s, US President Richard Nixon took the US off the gold standard. There were bouts of wage and price controls, gasoline rationing, and oil embargo and political turbulence. From 1970 to 1980, the price of oil went from roughly $1.21 US per barrel to about $40 a barrel. Gold went from roughly $35 an ounce to over $800 an ounce, and the CRB commodity index moved up about 300% during the decade. Rick, in terms of where you were at the beginning of the decade, I understand you graduated high school in 1971. You started college at the University of British Columbia, and you were contemplating a career at that point in natural resources tax law. Is that right?
That's absolutely correct. I mercifully was saved from a career in law by a lawyer who told me that I would be unhappy about it, but the rest of it's all correct.
All right. While you're in college, I understand that you entered into the hospitality business and became acquainted with some of the living legends of the Vancouver Venture Exchange. And with your hospitality business, you were able to develop quite a rapport with some of these living legends. Can you talk about that experience?
That's also true. Emigrating to Canada, I had to have a job to go through school, and the only marketable skills I had were that I was a very large, aggressive young man who had spent 10 years boxing. So my initial employment was as a bouncer so that I could work at night and go to school during the day. Through, I laughingly say now, one mistake after another, I came to own establishments rather than just working in them. And one particular establishment became, let's just say, the nexus, or at the very least, the chief watering hole for all of the people who went on to make the Vancouver Stock Exchange what it was. And I need to say, Takoa, that while my university education was around natural resource finance, I honestly learned the intricacies of natural resource finance better serving alcohol to the people who were involved in doing it than I did in courses. It makes sense in retrospect that a tenured professor who is an academic would know less about the thrust and parry of finance than people who were working every day in finance. But I am delighted that my hospitality career both furnished the capital to go into the extractive industries, but much more importantly, furnished me the knowledge that allowed me to be successful over the next 50 years.
Rick, I understand that in 1974, that was when you started doing investor relations activities for resource companies. And in 1976, you became a full-time resource investor. This happened in the interesting market context of 1974. As you recall, there was about a 30% decline in the Toronto Stock Exchange and about a 40% decline in the S&P 500. Interestingly enough, the American large energy companies, Exxon and Chevron, they participated in that large decline despite the much higher oil prices. Rick, did that decline, did that impact your area of the resource market, or did it create fertile ground in any way for your activities in subsequent years?
Absolutely, positively created fertile ground. In the early part of the decade of the 70s, gold in particular, but gold stocks in general, were on fire. And there was no particular need that anybody might have of somebody who could translate sometimes rather complex stories into actionable information ideas, because the market was doing it for them. Beginning in 1974, the Fed tried to raise interest rates, and the consequence of raising those interest rates were that a broad range of commodity stocks and other stocks, frankly, declined pretty precipitously in price. And it was the turmoil caused by those price declines that allowed me to work with people that became really, truly legendary resource financiers in the future. In particular, in 1974, Adolph Lundin. He would have had no use or no need for me in 1970, 71, or 72. By 1974, he had a couple of companies in the stable, And attracting investors was nowhere near as easy as it had been in the years before that. So in truth, understanding that a 1 or 2 year decline wasn't going to derail the resource thesis. In other words, having the courage to participate and then having a need for my participation meant that I was extremely lucky in the period that you described.
Rick, to circle back to 1971, Nixon took the U.S. off the gold standard at that time. Do you recall, was there much popular discussion of that topic around you? And looking back on it now, how do you interpret that event in retrospect?
The stage was set for that, Tekoa, in 1965, 1966, 1967. During that period of time, remember that we're coming off a 20-year bull market, or in the midst of a 20-year bull market. Then the period 1946 to 1966 was 20 years of unalloyed American glory. Lower interest rates, low inflation, American hegemony. Yes, the Cold War was there, but really, truly sort of American hegemony. And with that came American hubris. We decided to fight the war in Vietnam and the war on poverty simultaneously. You're too young to know this, but we lost both. And what we were left with at the end of the decade of the 60s were fairly high marginal tax rates and unserviceable debt and deficits. What Nixon did, and remember, he took foreigners off the gold standard. Roosevelt had taken Americans off the gold standard much, much, much earlier, knowing that he couldn't pass his counterfeit paper to us if there was an alternative. But Nixon took the foreigners off the gold standard. Prior to that, you could exchange US dollars for gold, were you not American. The foreigners, in particular Charles de Gaulle, looked at the circumstance in the United States with out-of-control deficits, out-of-control government spending, and out-of-control entitlements, and decided that rather than hold euro dollars, he would prefer to change them for gold. Nixon looked at that and said, how can we perpetrate fraud with a knowledgeable counterparty? And close the gold window. But I think it's important to note that he did that in the context. It wasn't something that happened overnight. He did it in the context of uncontrollable strains on the US dollar. What it did was really clarify for people who cared the circumstance that the United States was in. Even to a high school student, which is what I was in the latter part of the decade of the 60s, the hallmarks of inflation were present. While I wasn't an economics student, I was smart enough to watch the price of a hamburger at McDonald's go from 20 cents to 80 cents. I was smart enough to watch gasoline go from 20 cents a gallon to $1 a gallon. Perhaps because I didn't have much money, the impact of inflation on my purchasing power struck me much harder and made me much more aware of it. But for the American public, coming off 20 pretty good years, it took a while for the impact of inflation on American living standards to become extreme enough that Americans took note. I would suggest to you that as early as 1967, the fiscal actions that took place in the 1970s, the reason for the fiscal actions became apparent. But I would suggest to you, too, that it wasn't until late 1971 or mid-1972 that the length and breadth of the American citizenry became aware of the really pernicious impact of inflation on their lifestyles. And I think that what Nixon did, while it didn't directly impact Americans, was sort of an icon for the circumstance that the American economic culture of the preceding 20 years was gone.
Moving forward, Rick, 1973, late 1973, the OPEC nations, they increased the oil price, and the Arab members of OPEC announced the oil embargo to the U.S. along with some other Western nations. And the barrel of crude oil moved in price from about $2 US a barrel to, at the beginning of 1973, to about $13 a barrel in early 1974. In the US, there was rationing and shortages of gasoline for passenger cars, and many drivers were waiting in line all day for gas. In early 1974, commercial truckers, they went on strike nationwide, demanding a rollback in gas prices, and fistfights occurring at gas stations, and striking truckers getting in fights with non-striking truckers, and so forth. So it was a tense environment, to say the least. This occurred when you were in college. How do you recall the social environment at the time? What do you recall people saying and doing around you?
Well, understand, Tekoa, that one of the reasons that I left the United States and went to Canada was the social environment. If you dial back again to the 1960s, going to school in the United States, at least in California where I lived, involved needing a gas mask to get to class. I left the turmoil of the United States, partly around the Vietnam War, partly around other issues, and went to Canada, University of British Columbia, which was basically an engineering school and extremely quiet. So a lot of the drama that happened in the US wasn't visited on me in Canada. Canada was at that point in time, and is still, a petroleum exporting country. And Canada maintained adequate supplies of oil and gas during the period that you describe, and enjoyed, frankly, a fillip in the national economy as a consequence of their efficiency as oil producers. A few things strike me about the circumstance that you describe. The first is that the cure for low prices is always low prices. The extraordinarily low prices that the oil industry received in the period 1963 to 1970, the incredible flood, as an example, of oil that came out of the Persian Gulf, those low prices discouraged production in other parts of the world. And it was really that enabled the hegemony of foreign producers to raise the oil prices. It was, in fact, the low prices and the fact that the low prices had squeezed out the inefficient producers that allowed the efficient producers to engineer the embargo. You will recall, too, that in the later part of that decade, when the oil price went above $30 a barrel, that the cure for high prices was high prices. A decade of high prices caused American and other consumers to begin to conserve and to substitute other materials for oil at the same time that they encouraged a flood of production. So I think the first thing that you take away from that, from an investor standpoint, is that the cure for low prices is always low prices. The cure for high prices is always high prices. The other thing that's striking about that period is the sense that the citizenry, exemplified in this case by the truckers, thought that the government was bigger than the market. The idea that the truckers advocated a rollback in the oil price when the government, despite their best protestations to the contrary during the election period, had no control over markets, would be touching were it not so stupid. I have been struck through my entire adult life at the naive response of the citizenry to government's ability to do anything other than interfere with markets and make things worse. What did the truckers exactly believe that the United States was going to do? Perhaps they were advocating us invading Saudi Arabia. I have no idea what they had in mind, but the truth was that the diesel price, save government as an example, foregoing sales tax, which I don't think would ever happen, was something absolutely beyond their control. The faith in government exhibited by Americans is at once touching and maddening.
Rick, moving into the late 1970s, as you pointed out, commodity prices continued to escalate. What did you resolve to do as a resource investor to take advantage of the situation?
Oh, sadly, Tekoa, I made an amazing mistake. I made two mistakes, really. During the decade of the 70s, you have to remember that I began the decade as a 17, 18-year-old guy with massive ambition and no means. As a consequence of being in natural resource-based businesses for that decade, I came out of the decade being an extremely wealthy young man. Two bad things happened to Tekoa. The first is that I conflated a bull market with brains. I thought that the increase in my net worth through the decade of the 70s had something to do with my skill, conveniently omitting the fact that the gold price had gone from $35 to $850, and the oil price had gone from south of 2 to north of 30. When the oil prices collapsed in 1982, I learned just how smart I was, which is to say not very. And I think the lesson that I didn't take away is that markets work. If you were to dial yourself back to 1977 or 1978, and you were to look at commodity price forecasts issued by all the so-called reputable bodies, OPEC, the Royal Bank of Canada, all those people, the Club of Rome, there was truly a Malthusian aspect to resource pricing. I remember that popular wisdom had it that we were going to run out of food and there was going to be mass starvation, 30 or 40 million people a year starving to death by the year 2000. The oil price was supposed to be $200 by the year 2000. Now, all of this Malthusian thinking around natural resources was very convenient to a young man who was in the natural resource business. And by all conventional thinking, I was going to be a blue-eyed sheik. That's how my banker described me at that point in time. Forgetting, of course, that markets work. When the real projections of the Club of Rome are looked at today, they become farcical. Food became cheaper, much more abundant. The price of oil collapsed from a high of 40 all the way down to 12. The price of natural gas, decontrolled natural gas, declined from $15 to 70 or 80 cents a thousand. And what happened to me was, because I had decided that debt was a cheaper form of capital than equity for some of my things, so as not to dilute myself, I learned a lot about credit too. I found out that the value of my assets was ephemeral. An oil well is worth a lot less at $12 a barrel than it was at $35 a barrel, but my debts were all money good. Meaning that I had to pay off at 100 cents on the dollar. So it was an interesting circumstance for me. Interesting in very painful, but I learned a lot. And the lessons that I learned there, markets work, that you are a product of your circumstance. You're a product of your effort too, but you're a product of your circumstance. Learning a lot about the responsible use of credit and how to organize your own personal finances. All of the things that led to my downfall were responsible for the successes that I've had since. I should say one other thing, Tekoa, that was very important to me that you likely wouldn't have asked me about. That was that in 1982, when my net worth went negative, when my investment objective was to get myself back to broke, I decided not to go broke. And I was able to get my principal creditors together and tell them that if they cooperated with each other and didn't jump each other in the credit line, that I would do my level best to work myself out of the situation and pay them back all the money, principal and interest. I was able to do that. It took me 4.5 years, but I was able to do it. And that had two major beneficial consequences for me. The first was self-esteem. I did what I said I was going to do, which made me feel better about myself. The second thing is that people who participated in this project, that is to say, the people who I had money to, and the community that they influenced, became my best backers through the next 2 decades of my life. So I realized that isn't a discussion of geopolitics or anything else, but it was an important lesson learned at the time. If you do the right thing and you communicate correctly, what is on the face of it a very, very, very ugly situation can be used to your advantage.
Rick, that circumstance, as I understand it, it was not a securities portfolio with any kind of margin lending or something like that. It was a private entity that you put together. Now, were you accumulating oil wells in that entity?
Sadly, Tekoa, it was all of the above. I didn't have any margin lending on securities. What I had was a couple of advances to other parties who defaulted. And in particular, I had a private oil and gas business that was funded both on carried working interests from selling participations to other parties and my own direct investments with a revolving credit facility. the revolving credit facility is restated in terms of its borrowing base every year, depending on the beginning oil and gas prices of the year. So you can have a large credit facility at $35 and no credit facility whatsoever at $20, which is what occurred to me. So one of the things that I was able to do is, in addition to oil and gas assets, I had a couple receivables. One of the receivables was from a broker-dealer operation in the U.S. Midwest that went broke. And although I wasn't the largest creditor to that broker-dealer operation, I was certainly the creditor whose debt comprised the largest proportion of his net worth. The consequence of that is that the other creditors elected me to go work that circumstance out with, first of all, disproportionate benefit to my interest and a performance bonus. And I was able to, in the course of about a year's hard work, liquidate that broker-dealer. And while I didn't return all the capital to shareholders or creditors, I distributed substantially more capital than they would have been able to receive without my efforts. I was well compensated for that, and that was an integral part of my digging myself out of the hole that I had dug myself.
Rick, you've developed a wonderful reputation as a financier in the natural resource exploration space, and so did you pick up speed with that activity of resource exploration finance after that experience, or was it during or prior as well?
During and prior. I've always had a real fascination for exploration. I've had a fascination for science, and being in Canada in the decade of the 70s and being involved in assisting in the financing of several successful exploration endeavors, it's a fascination that's never left me. I also enjoy complex topics. I enjoy being involved in problem solving where there are lots of variables. And that really, really, really describes exploration. I like businesses where the distribution of information is inefficient or hard to understand, and where the harder you work, the more competitive advantage you generate against your counterparties. And again, that describes exploration. What I didn't realize, Tekoa, that I was doing in that decade was building what was then called your Rolodex, now called your contacts. I did my first transaction with Adolph Lundin in 1974. And I would say that my relationship with the Lundins has been my most important business relationship for the ensuing 50 years. I went to university with Ross Beatty, who went on to found 14 successful mining companies in the ensuing 50 years. I became acquainted with Chester Miller, rest in peace, who was also an extraordinarily successful mining engineer and mining explorationist. And so the period, say 1974 to 1985, in addition to giving me some operating experience, gave me a wonderful range of contacts that I could invest with, contacts that I could ask questions of, and truly, I need to say that by 1990, I had all the contacts that I needed for a successful career. I've often thought, frankly, that if I hadn't done business with anybody after 1990, who I hadn't met and done business with before 1990, that I would have worked a quarter as hard and made twice as much money. The truth is that Pareto's law works well in most forms of business. And I had the good fortune in the first 10 or 15 years in the mining and oil and gas business to meet 10 or 15 serially successful natural resource entrepreneurs, and developing those relationships with them, developing trust with them and in them, developing the ability to understand how they think and how to participate in their successes but avoid their failures is something that served me extremely well since.
Rick, I'd like to ask you about the 1980 to 1981, the commodity price peak for many commodities.
Yep.
There was also a peak at that time, as you recall, in the Fed funds rate, which exceeded 19%. What do you recall from that period as being some of the most extreme events and behaviors that you saw around you?
Well, one was my own behavior. When the prime rate went from circa 11 to circa 19, the writing should have been on the wall to me, with as much debt as I had, that the debt service was going to be a much more serious issue, and that it would alter investor behavior. If you were taking risk for a 25% internal rate of return, when you could get a riskless 19 and do no work whatsoever, it should have occurred to me that capital would flow from risky activities to riskless activities. In other words, they would flow from oil and gas drilling to the US 10-year Treasury. That's what happened, but sadly it took place without me. On the other side of the circumstance, the upside blowout in resources, if you haven't experienced it before, is extremely seductive. You work for a decade around a paradigm of resource scarcity. You work for a decade around the Club of Rome sort of Malthusian discussion of resources. And this incredible move to the upside is merely vindication of what you already believe. If you don't go into it with the historical sense that the cure for high prices is high prices, what happens is that this move in prices appears to you to be the logical outcome of the narrative that you bought into 10 years before. That's what happened to me. So I missed this upside blowout in its entirety, for which I have myself to blame.
Rick, I think you've probably answered this question in bits and pieces here, throughout this conversation so far. But if we reflect on that 1970s decade as a whole, your building of businesses amidst that bull market, what were the main educational lessons that you took from that experience?
First of all, markets work. The cure for low prices is low prices. The cure for high prices is high prices. Never forget that. Learn to love hate. At the beginning of that decade, commodity prices were low because commodities had underperformed other asset classes for 20 years. The fact that the other asset classes had performed and were arguably, at least with regards to the Nifty 50, overpriced didn't occur to people precisely because they had performed. And that performance had numbed people to the risks that they were running. With regards to natural resources, the fact that they had been cheap for 20 years meant that they were always going to be cheap, except, of course, the cure for low prices is low prices. It was that experience of the fact that markets work that enabled me in 1998 and then again in 2022 to participate early and aggressively in both uranium booms, which made an enormous difference in my net worth. It was the same lesson that allowed me to understand that during COVID, when the oil price fell to being briefly negative, and when Exxon got kicked out of the Dow 30, that these were one-off events, that a recovery both in the oil quota and in Exxon was inevitable. Those are lessons that came about to me as a consequence of experiencing the decade of the 1970s. The second lesson, which unfortunately took me longer to learn, is that the most important part of finance is time. You need to invest in a way where time is on your side so that you benefit from compounding. That's not what you want, particularly as a young man. As a young man, you want your thesis to be validated before the next long weekend. And you want to make money quickly. And you think that what you want matters to somebody other than you, but it doesn't. When I look back at the successes that I enjoyed in the decade of the 70s, and the successes that I've enjoyed since, the real successes, the ones that changed my net worth and my reputation, took 5 years or 6 years or 7 years or 8 years. Time has to be on your side. The third thing is that people matter a lot. if you look at the distribution of success in natural resource finance, and I would suggest probably too in other realms of life, but I don't know them as well, what you learn is that a truly disproportionate amount of the success is enjoyed by a relatively few people. The 80-20 principle, as it's commonly known, or Pareto's law, as it's known in sociological circles, suggests that 20% of the population generates 80% of the positive utility in any given task. And less well known is that there is a different 20% that generates 80% of the disutility or aggravation. What you learn is that if the task is large enough and the population base is large enough, that if you run either of those 20% lips through the same performance dispersal curve, they conformably align, which is a fancy way of saying that 20% of the 20% do 80% of the 80%, or 4% of the population generates 64% of the utility. And I think you can run the same performance dispersal curve at least one more time, which is to suggest that 8/10 of 1% of the population, or to make the math simple, 1% of the population generates 40% of the utility. What that means is that if you hang out as an investor with the serially successful, while you will miss a couple of newcomers, statistically, the importance of those newcomers is insignificant. If you invest continually, faithfully, and for the long term with the best of the best, you will have statistically the highest probability of good outcomes.
Rick, to ask you for a summary of today's economic conditions, that's probably best left for another discussion. But some of these notable events that we saw in the 1970s and some of the experiences that you had in that cycle, do you think Westerners and Americans in particular, will they see some of those events again, such as the rapid currency depreciation, embargoes, shortages, price controls, as well as the human behaviors in between?
I don't know. I mean, honestly, I don't know. I can give you three broad observations, probably. The first is that pessimism, real pessimism, is futile. We will, 20 years from now, be better off than we are today, maybe immeasurably better off. When I look at everything wrong with the United States, as an example, I still look at a culture where 5 or 6 young, pimply-faced kids can take over a garage in Sunnyvale, California, and out pops Apple, out pops Google. The truth is, with fits and starts, our individual creativity and tenacity has thus far always been able to fund our collective stupidity. There have been times where that's been a challenge, but we've done it. The second thing is that the world is much bigger and much more inclusive. I don't mean to sound politically correct, but that garage doesn't need to be in Sunnyvale anymore. It might be in Lagos. It might be in Chongqing. It may be in Jakarta. And that's a very, very, very good thing. A very good thing. It means that the United States doesn't have to carry the world anymore. And there will be a time, I think, when the world carries the United States. The bad news is that political solutions to private problems are increasingly popular in the world, including in the US. And the arithmetic that confronts us as Americans is substantially worse than it was in 1970. In 1970, you had a young workforce just coming into their savings and investment years, the so-called baby boomers. You had many more working people than you had beneficiaries for public programs. And so this madness, however thoughtfully conceived or, was affordable. Very different now. We have a lot of retired people, a lot of people sucking on the system and not so many people contributing to it. And the arithmetic overall isn't so pretty. The on-balance sheet liabilities of the US government before state and local debts and agency debts exceeds $34 trillion. A substantial premium as an example to annual GDP. But the scarier number is that the off-balance sheet, the net present value of the off-balance sheet liabilities, Social Security, Medicare, Medicaid, military pensions, government pensions, That number, according to the Congressional Budget Office, exceeds $100 trillion. So the balance sheet of the federal government is $120, $130 trillion upside down. And we're trying to pay off this debt, including the debt to each other, with a budget that adds to the unfunded current liabilities to the extent of $1 trillion every 100 days. This is truly unsustainable. I suspect that the way we get out of it is that we begin to means test benefits, that we reduce, in a real sense, benefits, that we age test Social Security. But the real way that we get out of it is we inflate away the obligations the same way that we did in the 1970s. Remember, in the beginning of our discussion, we suggested that between the war on poverty and the war in Vietnam, strange parallels to today, that the value of our obligations was greater than our political will to service the debt. And the way we did it is we inflated away the purchasing power of the US dollar. We devalued the US dollar surreptitiously by 85% over the decade of the 70s. And I think that the only way that we have out of $130 trillion in liabilities, where we're adding to that number by at least $3 trillion a year before the accrual of Medicare, Medicaid, and Social Security, is that we inflate away the net present value of the obligations without increasing the nominal price of the benefits. That means that people your age, if they're thinking about a retirement that includes Social Security, Medicare, Medicaid, you better think again. My generation voted ourselves all kinds of cool benefits, but we forgot to pay for them. We left you the bill. And while I apologize for that, laughingly, the solutions that you dream up for yourself are going to have to involve yourself. People who don't take into account the twin problems of society coming to depend less and less on entitlements in government, at the same time that private wealth is experiencing challenges due to inflation. People who don't understand that vice for the next 10 years, I think are going to be real, there's going to be a real ugly price to pay.
Rick, in wrapping up, how can our viewers follow your work?
Well, the easiest way, if they care about natural resources, is to go to my website, ruleinvestmentmedia.com. List your natural resource stocks, and for no obligation and no charge, I'll personally rank them, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments have any value. For people who care about being active investors, by all means, go to our boot camps. We have online 8-hour-long symposiums 4 times a year with deep dives into various aspects of investing. And the most important thing I do annually is the Natural Resources Investment Symposium, this year, July 7 through 11 in Boca Raton, Florida. Whether you attend personally, which I would prefer, or from the comfort and convenience of your own home via live stream, we're going to give you 60 hours of great programming in 4 days, more than you can absorb. The proceedings, the entire proceedings will be taped, including the breakout sessions, and you could, can, and should review those tapes several times so that you get the benefit of all the programming we give you. That particular event and my boot camps, and in fact, every other educational service I sell through Rule Investment Media, comes with a gold-plated money-back guarantee. If you go to the conference in person or attend via live stream in the comfort of your own home and you think that the content that I have given you isn't worth the tuition that I charged, email me. Gold-plated, no questions asked, money-back guarantee. The financial risk is always mine.
Rick, thank you for sharing some of your life experience with us today.
A pleasure, Takoa. I hope it saves some of your listeners some of the scars that I earned in the latter part of the decade of the 70s and the early part of the decade of the 90s. And I hope, too, it contributes to the success that I've enjoyed since then.